Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk to you about Alphabet, and what I find compelling about Alphabet. So we're going to discuss its recent results, then we're going to talk about two different businesses within Alphabet that I find particularly compelling. That's YouTube and Google Cloud, and then we're going to talk about its valuation. So let's just get right into it. So, investors were pretty much expecting to a large extent that Q2 21 was going to be particularly strong, because if you remember, Q2 2020 last year, was particularly weak, and you can see here in the graph that the revenues were flat year over year in the growth rate, so they already had a very easy comp, so investors were largely expecting to see a very strong performance this year. But even as we unpick and go through that, I think that there's a lot here that's very compelling. So YouTube approximately makes about 11% of total revenue, and YouTube is actually growing at 84% year over year. So YouTube reaches approximately 2 billion monthly active users. That's a very sticky platform, and it really is resonating very strongly with advertisers. So I've got a quote here that I'm going to try and kind of paraphrase, and it shows that during the call they said that advertisers are reaching out to YouTube because they're finding that 70% of consumers watching YouTube are not the same as they're watching on linear TV. So for advertisers looking to reach a different demographic and spread the awareness of their brand, this is something that's very, very compelling. And if I just cast our minds for a few weeks ago when Netflix reported their results, they talked about linear TV and cord cutting particularly, still being quite a new opportunity. And if you think about it, Netflix still saying that cord cutting is still quite embryonic, it really validates a lot of this opportunity in YouTube, but also other platforms, for example, the Trade Desk and Roku. So connected TV, according to many comments of many of these companies, is still a very strong and compelling business opportunity, and that the total addressable market is still growing at a very strong clip. So to hear during the call that Alphabet is saying, okay, according to Nielsen, TV advertising is still cheaper to advertise via YouTube than it is to advertise on linear TV, and that you have a higher reach, then you get in YouTube's analytics and very high return on investment. So for advertisers, that's really something that's quite compelling. The other opportunity that I wanted to point out is that Google Cloud was up 53% year over year. So if you look at, let's say, AWS or even Azure, these two companies, they're so big that they're not really growing at that rate anymore. So for Google Cloud to go into what I felt before these results was a saturating cloud opportunity, and to be still growing at 53% year over year, that's very, very strong. And now Google Cloud makes up 7% of Alphabet's total revenues. So this is something that is starting to be quite a meaningful needle mover for Alphabet. Now, you may counter that and say, okay, yeah, perhaps they're growing really, really fast, but Alphabet's cloud business is only marginally operating at break even still. So if you think about it, if you compare with AWS just put out kind of their weakest performance, but the operating margins were still 28%. So if you think about it, it is a slight fall down from, let's say, closer to 30% that it has been doing for AWS, but for Google Cloud to be just kind of still unprofitable, close to break even, but still unprofitable, they still have a lot that they need to move forward in to get that operating leverage once the infrastructure investments start to pay off. But for them to still be growing at a very strong clip, I really think that it talks about the power of the analytics and the power of Google Cloud's overall platform. So these are two opportunities that I think that investors are not really paying sufficient attention towards. Everyone talks about Alphabet and how advertising is so big, but if we go beyond that headline, I think that there's still a lot here that is not quite priced in sufficiently. Now, I put out this headline here, free cash flow and food for thought. So during the quarter, during Q2, Alphabet reported 16 billion of free cash flow. Okay, so that means in essence that for every $1 of revenue that Alphabet is making, 13 cents drop to shareholders as free cash flow. So if you think about it, those not so many businesses are able to have 13% operating margins, but Alphabet actually reports that as free cash flow, and 80% of its free cash flow during the quarter was returned to shareholders. So if you remember, Alphabet has a very large net cash position, and they're repurchasing a very strong number of shares, a very large number of shares. So during the quarter, they actually said, we're going to increase the amount that we repurchase up to 50 billion. So there's a very strong repurchase program in the background here. Now, by my estimations, if we conservatively estimate that Alphabet's free cash flow over the next year grows at 20%, that means that this time next year at an annualized rate, it's going to be coming into approximately 80 billion of free cash flow. For a company that's priced at a 1.8 trillion market cap, that puts the stock at approximately 22 times forward free cash flow. That's very, very compelling. If you think of Alphabet as a business that's capable of growing at 20%, for it to be priced at just 22 times free cash flow, that's really, really cheap. So I think that however we dissect this opportunity, I don't think the investors are really pricing in a lot of its future potential. I suspect that the investors are thinking that at some point, Alphabet's growth rate has to slow down, and that has been something that investors have been thinking about for a long time, but the facts don't transpire as such. They're really, really growing, and they're a very strong free cash flow generating company. So if you want to find out what kind of stocks I'm invested in, don't forget to check out my marketplace. It's called Deep Value Returns. I'll tell you the stocks I own and why, and I'm not going to replace your investment process. I'm just a place where you can come along and pick one or two ideas that you want every so often when you're looking to source ideas. You're welcome to do a totally free trial to see if it suits you, and cancel anytime before 14 days, and you won't get charged anything. So there's really no reason not to kind of get involved. And if you like it, you stick around, and there's a large investment community of value investors that I hope you find quite useful. See you soon.